Hey, you guys, welcome to another episode of Keeping It Real Estate. Today, you guys, I want to talk a little bit about the 2026 supply cliff and the coming rent surge that we see coming in the multifamily market. And note this podcast and let's see what happens over these next 2-3 years as we see new supply fall off a cliff. So there's this 2023 and 2024 construction freeze. And when I say that, I mean interest rates, they spiked and construction costs, they surged in 23 and 2024. And you had these developers completely pull the plug on new apartment projects. Banks stopped issuing construction loans, and the math for building out the ground up simply stopped making sense. And so a little more history for you guys. I'm going to go back a little further. Is back in 2020, 2021, when rates were so low and interest rates were bottoming out, there was a period of time where rents were going through the roof and apartments were peaking in value. And it was a time, if you sold, you made very, very good money purely due to timing, right? You may have overpaid in 2020 and then flipped and sold in 2021 just because rates went down and you got lucky with your timing. And so where we are now is that new supply that was started back in 2021 when rates were so low, it came to the market and it's being absorbed. It's been absorbed. The process of absorption has been happening over these last 2-3 years. And it's really brought rent levels down because when more product comes on the market, there's more choices for people to go rent, right? If you're a tenant and you're going to go rent, you're going to go shop the best properties you can. And when there's more places to live and not enough people, there's more options, rent's coming down, vacancies are going up. And so that happened in 2023, 2024. And then as we know, rates rose quite significantly. The Fed had to do something, inflation's ripping, and that stopped the new supply construction that I'm talking about here. And we've had this 24-month lag effect. So it takes on average 24 to 36 months to permit, build, and lease a large scale apartment complex. And the projects that were canceled or paused in 2024 are the exact buildings that should have been delivering keys to residents right now in 2026, but they were never built. Right? The pipeline of new supply is suddenly dropping to historic lows. And so when that happens and you don't have a bunch of new product coming, which we can see, the data tells us how many new units have been started and when they're going to be delivered. And we can see it's like a cliff. If you look at the charts on CoStar, it is like a cliff. If you look at 2023 and 2024, they show the quarterly amount of absorption in new units, and it's extremely high in some of these large markets like Dallas, Fort Worth. And I'm really talking about Dallas today. And then start 2026, it is like a wall. It is a cliff. It drops off. And so there is not a lot of new supply coming, and there are still a lot of people moving to Dallas because there is major job growth and major population growth in a tax-friendly market like Dallas. So what that's going to do is as people continue to feed into Texas, to Dallas, Fort Worth, it's going to put pressure on what is now there. And when there's not a bunch of new product coming, but we still have a ton of people moving in, it is going to put pressure on rents purely due to supply and demand. One more thing, if you're an accredited investor and you've been thinking about getting into real estate, but you're not sure where to start or how it fits into what you're already going to be doing, we opened up a few capital positioning calls each quarter for these new investors. Not because we're trying to create fake urgency, it's literally just capacity. Our team spends a real time preparing for each of these calls, so we'll cap it. So if you want to have a real conversation about your capital or your tax situation, and whether this kind of structure makes sense for you, grab one of the remaining spots, links in the description. And if you look at U-Haul, you guys, this is an interesting stat. We track this very closely. If you look at one-way U-Haul trips, right now, Dallas is the number one local destination of one-way trips for U-Haul, and it has been the last 2 years. That tells us people are moving to Dallas and stopping right there. So the renters rent by necessity. Right? It's called the renter by necessity collision. So at the exact same time supply is vanishing, demand is structurally increasing. You've got mortgage rates, you guys, that also are staying elevated, and these single family home prices, they just remain historically unaffordable. I mean, we are turning into a renter's nation, and that's going to continue to get worse purely due to inflation. So you've got millions of high income millennials and Gen Z professionals that are permanently priced out of buying a home. and they're choosing to lease these high quality multi-family units for longer durations, which is driving up occupancy rates. And I can tell you right now, it's a step down effect, right? If you got a whole bunch of people filing and filling into these A class of units, now you have to raise rents. It prices out a certain demographic, and now those renters become B class demographics. B class apartments is 85 product till about 2000, as long as it's well maintained. And then you've got the C product, which is the step down below that, and then D, which is basically the don't ever go zone. But this supply cliff opportunity, you've got this last 2 years, new supply has kept rent growth relatively flat. And we've even seen some negative rent growth, but flat rent growth. And the artificial ceiling, it's about to vanish. So the strategy, you guys, is you have to acquire existing stabilized properties right now at a discount due to the debt maturity wall. So what I mean by that is you come into a market, amazing market, like we're buying a deal in Plano, Texas right now because it's an A plus market. And when I say A plus market, I mean it's got the best schools, A-rated schools. It's got actually a nationally ranked high school system there, Plano ISD. And then you've got Whole Foods across the street. You've got median household income of $105,000. You've got median house values of $800,000, which basically makes people want to get into your apartment so that you can access the beautiful retail, the school districts, the safety. And so to be able to get into an apartment for 15, 16, 1700 bucks instead of a mortgage for 4, 5, 6, 7 grand, it allows you to be in that submarket when you're not going to be able to find a way to get into that school district or that submarket without it. And what we're doing is we're looking for folks that are forced to sell. Right? I want you guys to hear that. When you're forced to sell something, are you taking top tier pricing, or are you taking basically anything you can get, bottom of the barrel pricing, and or potentially some heavy negotiations during due diligence? Yeah, it's obvious. If you are selling right now, you are a distressed seller. You would not sell real estate right now if you did not have to. So that's what's happening right now is you've got this supply cliff. And it fully hits in late 26 and 2027. So Granite Towers is going to hold highly desirable cash flowing assets in a market with zero new competition. That's what we're accumulating right now. And that's going to allow us to aggressively push rents. And as you guys know, the way you add value in apartments is you increase the net operating income. And you're going to do that by one of two ways or both ways. You're either going to increase the income and or you're going to control or reduce your expenses, thereby increasing your net operating income. And a real simple fact to leave you guys with here is if you increase NOI by $1 on the exit at a 5 cap, if all things are equal, it's $20 of valuation. So if we can execute our value add strategy efficiently at Granite Towers, and we can buy this deal in Plano, Texas, 229 units, and we can move the net operating income by $1 million over a 5-year period, which is what our business plan is, we'll effectively create $20 million of value as long as all things are equal. If interest rates run, totally different story, of course, because interest rates do affect cap rates. And is it possible that interest rates go up? Sure. But as long as you're in a cash flow state, and as long as you're driving net operating income, you're in a safe spot and not forced to sell. The folks who are forced to sell right now are the losers. That is the opportunity, ladies and gentlemen. If you can buy great real estate and restructure the debt, the deals aren't bad deals. The debt's just not structured properly. They're over leveraged with variable rate debt and they have to get out. The other piece to keep in mind, one last piece that I want to add in here, wasn't planned, but I just want to make sure you guys hear this. If you're looking at real estate right now and you're coming in and buying real estate, be extremely detail oriented on your due diligence process, because if sellers have bridge debt, they're likely in a lockbox, meaning the bank controls the income. The bank steps in and says, we're in control now. We'll collect the rent. We'll pay us first. And then after we get paid with our interest, we'll give you money back to pay your bills in a specific order. And generally, there is nothing left to take care of that asset. So the deferred maintenance is stacking. And that is an opportunity for the thorough buyers to be extremely diligent during due diligence and make sure you account for everything that property is going to need for the next 5 to 10 years. Get that in your budget before you close, because as soon as you sign on that dotted line, all the good, bad, and ugly, that's yours. Good luck, and thanks for listening to another episode of Keeping It Real Estate.